So we started our detailed discussion of the world of deductions, right? And we observed very, very important phenomena, and that is it's completely opposite approach from the government's perspective to the question whether something is deductible or not, because the answer, default answer is it's not deductible unless, right? As opposed to an income, it is taxable unless we tell you otherwise. So what this means is that in order to take any deduction against your income and thus decrease amount that will be due to the government due to the decrease in tax base, you have to satisfy requirements. Okay? If in income there was no thinking, you get it, it's taxed, unless you want to start thinking and try to figure out whether it should be taxed or not. In expenses, you can't unless you show that you satisfy requirements for this particular expenditure to be allowed by the government as a deduction, and therefore for you to receive tax benefit, right? And you receive benefit because deductions, again, decrease your base, which results in less taxes due to the government, which is beneficial to you. Thus, the term tax benefit. Okay. So, we started with above-the-line deductions, and our first item was trade or business expenses, right? And before we could talk about trade or business expenses, we said we need to understand what trade or business is, and I gave you a three-pronged test. First, most important one, there has to be expectation of making a profit, okay? We cannot possibly talk about any type of business activities if there is no expectation of making a profit, okay? Sometimes you wonder how come people you know are involved in this business, they never make any money. They don't treat it seriously. Some of them don't even care. Some of them do it for fun. Well, that's the results they get, okay? So you have to have expectation of making a profit, and in reality, once you have an expectation making a profit, then other prongs kind of have to follow, right? It means you have to treat it seriously, regularly, actively, right? So expectation making a profit, regularity and continuity of operation second, and active participation third, okay? You need all three, okay? All three. Don't get excited in the exam. You satisfy first, and then say, okay, I have expectation making a profit, that's it. No, all three. And even if you satisfy all three requirements, does it mean that deduction is allowed? Does it mean that the expenditure is such for which the government gives you a right to take a deduction, thus get tax benefit? Answer, not necessarily, because even if you have trade or business, even if you have established that you have a trade or business, you still have to demonstrate that the expenditure from this particular trade or business is ordinary, necessary, and reasonable, all three. And naturally, of course, also relates to the business, right? If you are in the business of making pizza and making delivery of pizza, and I don't know, you happen to incur air conditioning expense in your bedroom where you sleep, what does it have to do with your business, right? So it has to relate to the business also. Okay? Now, once you satisfy those requirements, ordinary, necessary, reasonable, right? And you have a trade or business, congratulations. As a general rule, your expense will be deductible as trade or business expense, which is above the line. And the beautiful thing about trade or business expenses, you're allowed to have losses, right? Which means your expenses could go beyond and above and beyond your income. Great stuff. Huge benefit. Should I do something? Sir? No? Okay. All right, cool. So, so that's something to keep in mind. Now, I said generally, right, even if you satisfy all those, because there are exceptions, like public policy. The expenditure, you could be in the trade or business, the expenditure could be ordinary, necessary, reasonable, yet, due to public policy exception, the government says, no, 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 right? So if you are violating some rules or regulations, right, you're stealing my spotlight, and I don't mind. It's okay.
He zoomed in on you. It's all good.
All right, cool. So if if you violate some rules and regulations, like get a ticket, speeding ticket, parking ticket, bribe politicians, bribe cops, okay, government says, no, 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 it may be, I don't know, ordinary, necessary, reasonable, but it's against public policy. We don't want you to do that. And on top of that, subsidize these expenditures, because if you take a deduction, right, you pay less taxes to the government gets less money, and in essence, they're paying part of that parking ticket for you. The government says, no, 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 we can't let you do that. That's why we have public policy exception, okay? Very important. Okay, well, since we started talking about violating the laws, right, we need to continue in that subject and talk about illegal businesses. And that's what we discussed, that as a general proposition, whether the business is legal or illegal, while FBI, Attorney General's office, and other departments of the government may care about it, IRS, frankly speaking, as a general proposition, does not care. Because whether business is legal or illegal, you still have to pay taxes. And that's point number one. And point number two, since you're going to be paying taxes, the government allows you your ordinary, necessary, and reasonable expenses that relate to this business, even though the business is illegal. Yes, we discussed who in the world would supply this information to the government, who would file tax returns, but smart criminals do that, okay? They do pay taxes, they do report income, they do get deductions. It's just that they may not classify the activity for what it really is, right? As you see all those movies and they ask a mobster, what business are you in? And the answer usually is, I'm in consulting business, or something like this, right? Well, that comes from tax planning perspective. That's what their accountant probably told them. All right. So, but of course, not all crimes are the same, right? So the government is really harsh on drugs, at least always was and still is from tax perspective. That could be changing, of course, right? Soon, as we keep losing that war and realize we could just make money in it as opposed to waste money in it. But for now, the law about drugs is extremely strict, right? And that is, well, you still have to pay taxes while selling drugs, illegal drugs, right? You are no longer allowed ordinary, necessary, and reasonable expenses, okay? Except depreciation, cost of goods sold. All right? So as silly as it may sound to some of you, that's what we have, okay? And that has to do with illegal businesses and IRS's approach towards them, okay? So that's that. Now, we also talked about situation where when you try to establish something being a trade or business, while you satisfy the first test, which is expectation of making a profit, you happen to fail one or both of the other tests, right? Which is regularity, continuity, or active participation. If that happens, congratulations and welcome to Section 212 of the Internal Revenue Code, which addresses, thank you very much, which addresses situations where expenses incurred in activity, like investment activity, for example, where you don't do it maybe regularly or actively, okay, but you do it for expectation of making a profit, okay? And whether you make a profit or not doesn't matter, really, in this case. It's, do you do this with the expectation of making a profit, okay? So this is really you don't have to worry about projection for now, but this is really what this section is all about. And we said if you don't do it regularly, continuously, or actively, you will be able to deduct expenses, but they're deductible now as itemized deduction, and not only itemized, which is a problem, because if you take standard deduction, they're lost. But even if you itemize, you may not get any benefits from these deductions if those expenses are below 2%. And even if those expenses are above 2% of AGI, you will still not get the full benefit of these expenses because first 2% of AGI is not deductible, right? It's the floor. So that's the rule on section 212. Luckily, we learned an exception to this harsh rule. I'm saying harsh because you find yourself in a situation where you made money, you pay taxes on the gross receipts, yet you get no deduction at all. The government says, well, it's okay, you're not really treating it that seriously. If you want to treat it seriously, just make it your trade or business, which means satisfy all three requirements. So whether it's really harsh or not, that's already a separate conversation. But the exception to this rule is if you are in a business that generates income in the form of rents or royalties, then the expenses from such activity, even though you don't satisfy regularity, continuity, active participation, you're in section 212, those expenses still go back above the line and deductible, just like trade or business expenses, above the line. Huge benefit. The reason I stressed that activity generates income in the form of rents or royalties is because some students get confused. And when I give an example, what if you are selling ice cream and you have rental expenses? Are those rental expenses deductible above the line because they're rental? Answer: no. We don't care what type of expense it is, whether it's rent or royalty. It doesn't matter. We care what type of income is being generated from business. If income comes in the form of rent or royalties, then any and all expenses that are ordinary, necessary, reasonable, of course, as always, go back above the line. So something to keep in mind. This is pretty much where we stopped last class. And before I go any further with bigger, better, more wonderful, exciting, and crazy, interesting stuff, I'll give you an opportunity to ask questions. Yes?
So for that last clarification with the rent and royalties, still need to satisfy the ordinary necessary?
Always. Before you're able to deduct any type of expenses, the expense must be ordinary, necessary, and reasonable when it comes to any and all expenses. Any other questions? Anybody? If you have a question, wave. There are a lot of you. I may not notice. You may blend in. Okay. No mas. All right. So, today, I'd like to continue the discussion of expenses. And last class, as we reviewed now, we discussed the types of expenses, their deductibility in certain types of activities. We'll continue with activities. We'll talk about later today, perhaps, about investigation business, about maybe hobby, and all the other crazy, exciting things. But before we do that, I just want to take a step to the side, small step, and talk about when the expenses are deductible in general, right? Let's take a little breather here. So, when are the expenses deductible? And the answer is depends. Excellent. Okay? Wonderful answer most of the time in any area of law as a general rule, except on exam. Okay. So it depends on the method of accounting you use, right? So let's go back to our good old buddy, cash method of accounting. Give me one word. Received, right? So please write it down. On the cash method of accounting, expenses deductible. Excuse me, did we say received? Are you serious? When it's spent, when it's paid, right? When you pay, right? So deduction is when you have an expenditure, you pay it, right? So when you spend it, meaning spend money in it, okay? So cash method, the key word is paid, okay? When we were in income, the key word was, once again, what? Received, right? So you report income when received. When you have an expense that you pay, the keyword is paid, okay? So let's underline, highlight, and put a star next to the word paid so we don't confuse the two. So expenses deductible as a general rule on the cash method when they are paid. Okay. So once again, as you all expect, you're sitting there and say, oh, come on, Professor, it can't be that easy. And yes, as you read for today, it's not that easy because there could be a lot of abuse. Oh, I have a lot of income. How about I prepay next, I don't know, 5 years of my, I don't know, some expenses, some office expenses, okay? So this year I pay no taxes at all. Sounds wonderful, good cash flow, and all the other stuff. Government says, not so fast, right? And just like very similar approach we saw on the income side, okay, the government has some limitations. So they allow you, for example, to prepay, okay, for maximum, there's a, once again, 1-year rule, remember? So if you are able to consume, to put it in plain English, the rule itself, the benefit of your expenditure by the year that follows the year of payment, okay? It's 1-year rule. Then you could take a deduction for the amount you paid in the year when you paid it, okay? So let's say today I prepaid next 3 years worth of supplies. I could deduct this year whatever I'll use up for this year and next year, okay, as a general proposition. The rest I will deduct as I use it up. Is that clear? Okay. Excuse me? Yeah, sure. If I prepay next 3 years worth of, let's say, office supplies, okay? This year, I could deduct. It's a 1-year test. Let's all, just in case nobody gets confused here, let's look at the book. So you could also find the definition there. Which page is that on? You guys remember? Yeah, it's on your page 9. Okay. So when you prepay an expenditure, okay, it's the, I guess, 1, 2, 3, 4th paragraph where it says tax court and IRS took the position that the asset will, if the asset will expire or be consumed by the end of the tax year following the year of payment, right? So this is the year of payment. Let me make it even more visual for you by exercising my wonderful drawing abilities. Because we don't want there to be any type of confusion, right? You're paying a lot of money. You cannot have any confusion. So year 1, and this is the year of payment. And this is year 2 and year 3, right? And let's say I prepaid for next 3 years. Whatever I'll consume, whatever office supplies I'll use up this year and next year, I could deduct in year 1. But whatever I'll use up in year 3 cannot be deducted in year 1. Everything else, or for year 4 or 5, will be deducted as I use it up. Is that clear? So if you prepay for the next 6 years, same story. Okay? You deduct year 1, whatever you use up in this year. Okay? For the next, you deduct them. I don't know if this is helpful, my drawing. But whatever you use up in year 1 and 2, you deduct in year 1. Everything else you deduct as you use it up. Okay, whether it's 6 years, 100 years, 60 years, so on, so year by year. Right? Now, of course, remember the concept of depreciation. If you have capital expenditure, right, then the only way to deduct that is through depreciation or amortization, right? Over 20 years, 30 years, 25 years, and IRS gives you schedules, and maybe we'll get to depreciation discussions. Yes?
So in year 1 and 2, you deduct in year 1 for 1 and 2, but what can you deduct in year 2? Nothing.
Nothing, you already deducted those expenses. Yeah. Okay? So there are other exceptions in cash method, but for now, for this basic introductory course, there's recurring item exception, all that stuff. We will ignore it. Okay? We may end up coming back to it. Now, let's talk about accrual method, right? So, again, under accrual method, what is one key word? Incurred, right? Incurred. So we have similar all events test, which helps us determine when the expenditure is incurred. Okay? Bless you. And that is, number 1, all events that determine, now it's the opposite from what it was in the income side, right? That determine taxpayers' obligation to make a payment. All events that determine taxpayers' obligation to make a payment have taken place. All events that determine taxpayers' obligation to make a payment have taken place. And the amount of payment can be determined with reasonable certainty, right? All events, it's really pretty much the same definition as you had an income side, only it's now about obligation. So all events that determine taxpayers' obligation to make a payment have taken place. And, second part of this all events test is, and the amount of that expenditure can be determined with reasonable certainty. Okay? But when it comes to accrual method, we add one more requirement, and that is called economic performance. So even though you have an obligation to make a payment, let's say you sign a contract with cleaning company that will clean your office after the party, and the contract says you are to pay or whatever it is, you cannot get a deduction until economic performance takes place. What is economic performance? It's whatever you bargained for has taken place. So if this is about cleaning your office, somebody cleaned your office. If it's about somebody, oh, I don't know, delivering computers to you, they delivered computers. Whatever you bargained for that expense has to have taken place. Without it, you cannot get a deduction. And we'll do homework problems on it to solidify this. Okay? So, same story. Okay? Same story, same deduction. Okay? So, when it comes to accrual method, there are other exceptions. There's also recurring item exception and so on and so forth, which we're not going to cover at this point. Now, so this brings me to a very exciting conversation, which is one of the two main conversations for today. And that is something that we'll discover together in our effort to approach and deal with and develop some rules using Socratic method. Question: trade or business? You have a trade or business. We already learned. You have expenses. You establish that you really have trade or business. Three-pronged test. You establish that expenses ordinary, necessary, reasonable. They're deductible above the line. No questions asked. Whether you have income or not, you're going to have a net loss. It's okay, right? We're all together? All right. What if before you start a business, unlike vast majority of people who just go and start a business, and then vast majority of businesses, what is it, about 80% of the businesses fail during the first 5 years, right? And then out of those who did not fail during the first 5 years, 80% of them fail during the next 5 years. Okay? So let's say you are wiser, and before actually starting a business, you do some homework, and some serious homework. Anybody's thinking of any type of business in the future, possibly starting? Sir, what are you thinking about? Yoga class? You raised your hand, right? I mean, your legs were raised too. I wasn't sure if you already started. Oh, you just raised your hand? That's it? All right, I'll leave you alone. That's fine. Anybody thinking of starting a business? Yes. What's your potential business? Restaurant, possibly. I love restaurants. It's a tough business, I have to tell you. It's such a tough business. But it could be very rewarding if done right. So, do you like to cook? And I like to eat. So let's say, and I'm sorry, what was your name again? Jennifer. So Jennifer says, I'd like to start a restaurant business. Okay? Now, any restaurant or a particular type of food? Excellent. Smart. Why? Because people go and say, okay, I'm going to start a restaurant because I like sushi. And they open a restaurant and it turns out there are 20 other sushi on the block restaurant. In fact, it's funny. One of the streets in Brooklyn, I always laugh when I'm there. On one block, there is 1, 2, 3, 4, about 5 sushi restaurants. And there is one bar, and outside of it says, no sushi. I just find it hilarious. Anyway, that you're a true entrepreneur, because entrepreneurs are really about making money, right? How you make it, what type of food people eat, it doesn't really matter. So, unless it's your passion to do this, right? So, if Jennifer, if you were to start a business, right, but if you would consider doing some homework first, what kind of homework do you think you would do to determine what to do and how to do and where to do?
I consider looking into what kind of foods are prominent or popular. If I was to come up with into a certain area, trees or introducing other foods into that area, or what is working well.
Brilliant, brilliant. Today we're going to increase your successes and your chances of successes. So absolutely, Jennifer says, look, you know, before I start a restaurant, first of all, I need to figure out what area I should do this in, right? So if you're, you know, if you want to do it in some particular area, right? Or if you have something particular in mind, like you said, introducing certain food, right? Well, then, first of all, you got to figure out what food that is, right? Do some homework on that. And then figure out where there is demand for it, right? So as you do all these things, guys, what type of expenses would Jennifer incur or could incur? Yes. Investigation expense. That's a very good name for general umbrella, but specifically, what kind of expenses? As she's investigating, what does that mean? Yes. Research and development, what does that mean? Sounds very, guys, you're into like these fancy, sexy expressions, but I don't know what that means. Jennifer, are you going to do research and development expense? Some, but what does that mean? I don't know. Give me specifics. Give me bread and butter. What kind of expenses? Travel, right? So Jennifer may end up traveling to certain places. She is in New York and it's cold, although today is gorgeous and yesterday. But maybe, maybe I'll investigate some, maybe, Miami is the place to investigate. So she gets into airplane, she lands in Fort Lauderdale or Miami, goes to the Strip, Ocean Drive, checks out all the restaurants there. And of course, that's airfare, that's cab, that's hotel, unless you're going to stay with your relatives, I don't know. Then you got to also taste the competition, wouldn't you say? Right? So all those restaurants there, oh my God, I don't know if they're good. How do I know? There's only one way to find out. So you have to eat everywhere, right? So you incur all those types of expenses. What other expenses could you possibly incur, Jennifer? Marketing, right? So although generally people, that's actually a huge point. Generally you start a business, then you start marketing, right? But there is a wiser way to do it. You market it. You promote, like there are some services that people are thinking of offering, and they just start advertising for it, and they see how much demand, how many people call. Oh, okay, people want this. Let's start creating this service, right? Like in computer industry, they advertise models. They don't have them. Once they get ordered, then they go start manufacturing them, right? So that's actually very smart. So marketing, travel, what else? Yes? Expos, yeah? Sure, you go to Food Expo and do some more tasting there, or talking to chefs, or try to steal chefs from other restaurants, or whatever it is. Very good. Bunch of expenses. Maybe you come up with a name. Maybe you need to investigate whether this name exists, whether maybe, all of these expenses, right? And yet you haven't even started the business. All right, ladies and gentlemen, $1 million question. Can Jennifer deduct these expenses? Well, one thing that I hope is clear to you is that these expenses are certainly not deducted as trade or business expenses because there is no trade or business. Right? Everybody understands it? So, and since in tax law, before you're able to deduct anything, you have to have an open path that the government said if you satisfy this requirement, you could deduct, and we haven't studied yet, all right? There has to be some exception. Now, let's step back for a moment. Jennifer went to Miami, tasted restaurants, stayed in a hotel, talked to some people about their perceptions. That sounds like a good time to me. Whether you investigate a business or not. Wouldn't you say? How do we know she was actually investigating a business versus just decided to take a trip vacation and call it business investigation, hoping to get deductions? How do we know? So, if she takes deductions for business investigation expenses, I'm IRS and say, no, 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 you just went to have fun, and we go to court, and you are, ladies and gentlemen, are the jury. What would you want to see as a proof that she really was investigating the business as opposed to having delightfully delicious and good time? Yes, all the way in the back. She needs to have a proof that this was done for the business, which is exactly what I'm asking. What kind of proof can she offer? Oh, so one way, one member of the jury says, well, if she already has a similar business, if Jen already has a business in Queens or Manhattan, and now she's investigating possible expansion, well, that kind of seems believable. What's the ultimate proof? She started a business. Ladies and gentlemen of the jury, I in fact started the business after that year in question. Wouldn't you say that's a good? Yeah, it's all. So the rules that I'm about to teach you is really what we just developed. together. Because the government starts with business investigation expenses deductible if one possibility, one tunnel out of Manhattan is if you have similar existing business. If you have similar existing business, well, we believe you. Plus, you know, if you have similar existing business, you go out and you taste the competition, whatever, okay, you need to know what they're doing, right? You need to know what trends, whatever, so whether, even if you don't investigate the new business, it's still important for you to know what's going on. It's justified as a business expense because maybe it will make your existing business better. Whatever the rationale was, the law says if you have similar existing business, deduction is allowed. Is that clear? Of course, there's a 400-pound gorilla in this room that nobody raised yet, identified yet, or put it differently, $1 million question, and that is what? What is similar existing business? What is similar? If Jennifer has pizzeria in Manhattan and she wants to open a sandwich place somewhere else, is that similar business? Yeah, I think so. If Jennifer has pizza business, she wants to open full Italian restaurant somewhere, is that similar business? I think so. If Jennifer has pizza business and she wants to open bike rental business, is that similar business? No. If Jennifer has pizza business and she wants to open a dance club, is that similar? I don't know. There are plenty of places that serve food and you could dance, right? There's a nice place in the village. What is that place? Cafe Wa. Anybody been to Cafe Wa? Oh, you guys have no life, I forget. It's great life. Oh, you've been to Cafe Wa? We're talking about Cafe Wa right now, I'm sorry. Oh, you've been there? It's an awesome place, right? Great music. And then you could dance between the aisles. And then if people get too happy, they dance on the stage, then they get kicked out. But, you know, once you do well in this class, I allow you to go celebrate there. So, you know, it's kind of gray, right? So something is obviously similar, something is obviously not, some things, I don't know, it's a question of fact. So the government came up with some guidelines, but essentially what they say is, look, if suppliers, consumers, customers, type of advertising you do is similar, then we'll call the businesses similar, if these are same type of consumers advertising or marketing campaign. Yes, sir. We didn't discuss that yet, not necessarily. We'll talk about it. I want to get there first. For now, we're talking about similar business. So similar business, whether you started a business or not, is deductible. And it's deductible in full. Now let's go back to your question.
If she opens up a corporation or an entity and then make expenses or like investigation expenses on that entity,
just because she changes the form of the way she does things and all of a sudden she creates a corporation as opposed to doing it on her own, that makes no difference. Makes no difference at all. Okay? Because still the question is going to be, what were these expenses? Business investigation, was there a similar existing? Just because you have the corporation. It just shows maybe a more serious approach, but it doesn't mean it's going to be allowed. Okay. So, and if those expenses are coming and you have existing business, then they're deductible, just like trade or business expenses. Above the line, when you incur them, end of conversation, nothing else to discuss. Any questions on that segment of the law? Okay? Simple, similar existing business, deductible, that's it. All right? Second possible situation. Yes, sir? Yeah, just like trade or business, which is above the line deduction. What amazing weather outside, right? I'm considering next class, if it's whether it's gonna hold up, to do it in Central Park. You won't be able to hear me though there. So maybe we'll have, we'll do a group tour. Everybody will have an earpiece. But like 250 people following me, there may be a problem with authorities. But that would be nice, wouldn't it? All right, maybe we'll wait for the real hot days. Maybe we'll do it on the beach, will be easier. All right, or maybe we'll do it in Miami while Jennifer is investigating her business. We'll help her with her investigation. All right, second possibility. You actually started a business. Whoa, that's so cool. All right, you started a business. So when you start a business, good news once again, the expense is deductible. Okay? Wonderful news, the expense is deductible. You got it? But of course, you guys are worried because there's something else there, right? And that something else is, since you started a business, and all these expenses went into the business, these look like capitalized expenditures, right? Something should be capitalized. So they're deductible over time. And that's the first rule. And over time means what? How many years? 180 months, which is also known as 15 years, right? So whatever expenses that you deductible, from the time you start a business, you start amortizing these business investigating expenses. Business investigation expenses, which are deductible once again above the line, just like trade or business, but over time, over 15 years. Is that clear so far? You got this? We could move forward. So far, simple. So then, some years ago, not too long ago, the government says, we want to encourage more business. Remember we talked about how the government uses tax law to encourage or discourage certain behavior, right? So the government said, what can we do to boost the economy, to make people want to investigate and start businesses? Well, what can we do? Let's look at the tax law. Well, right now, they investigate and they start a business, they could amortize over, 15 years. Can we do something more for them? People need upfront cash in the pocket. They just start a business, no money. All right, let's do something else. In addition to all that, if they start a new business, we'll allow them $5,000 deduction up front out of those expenses. Right? $5,000 up front. Wait a second. But should we give it to everybody? I mean, some people have little money, some people have a lot of money, spend a lot of money, maybe they don't need as much help. Okay, cool, no problem. So how about we give everybody $5,000, but not quite to everybody. If somebody spends on business investigation expenses more than what? $50,000, then every dollar above $50,000 will go towards deduction of this upfront $5,000 deduction. Okay? So the ceiling is $50,000 in expenditures. Any amount above $50,000 reduces the upfront $5,000 deduction. Now, I fully realize that these situations are best digested through my gorgeous drawing techniques. So let's say somebody spent $60,000. How much is up front? $5,000? $10,000? I hear? Anybody more? Anybody less? How much are you deduct? Now, normally it's $5,000, right? But we said once the amount exceeds $50,000, any excess over 50 reduces this 5,000. How much up front once again? Can I see some hands in the air? I hear 10,000. Anybody more? Zero. Zero. Why zero? Any amount over $50,000 reduces dollar for dollar upfront deduction of $5,000. So how much is excess in this case? 10,000. Is it more than 5? Yeah, 0 upfront. So all we do, we now amortize, right? We take 60,000 divided by 15 years, or 180 months. Okay? And that's, is that clear? She's confused. Why are you confused? I don't know either. Sure, I could try again. The government says you're allowed to take your expenditure of $60,000 and amortize it over 180 months, right? But before you do that, we'll give you additional benefit. Extra $5,000 deduction out of the expenses you spent. You could deduct upfront year 1, then you start amortizing. But if you spend too much money, then, and what's too much money? Over $50,000. Then the amount over $50,000 reduces this $5,000. So you spend $10,000 more. So there's nothing left of this. And that's why it's 0. To make it simpler, let's say you spend $52,000. How much upfront are you allowed? $3,000, exactly. Why 3? Normally 5. Your excess is how much? 2, right? And it reduces dollar for dollar. So you have left 3 upfront as soon as you start the business, right? How much are you going to be amortizing now? 52? 49. That's another common mistake on the exam. You already deducted 3. You spent 52, you deducted 3. How much left to amortize? 49 over 180 months. You spent $47,000. How much up front? $5,000. How much amortized? 42 divided by 180. Now spend 15 seconds looking at this and then see if you have any questions. Yes.
So the first year, you deducted 5,000, let's say, in the last example.
Last example, you deduct $5,000 plus amortization of the remaining balance for each month since you started the business. So if you started a business in September 1, then it would be September, October, November, December, 4 months of amortization plus $5,000 in case of category number 3, my example number 3. Yes?
So
What
what if you spent $55,000?
if you spent, see, I know I have accountants in the room because you guys want to play with each and every number. Okay, $55,000 spent. How much up front? 0. How much amortized? Yeah, because you didn't amortize. Right? 55, so you spend 5,000 more than allowed. That reduces 5,000 allowed. It's 0 left. But you didn't get to deduct anything up front. So you amortize full amount that you spent. No. This is only conversation that applies to situations where you don't have similar existing business, right? Because if you have similar existing business, there is no conversation. All of your expenses deductible above the line, period. In full, when incurred, as incurred. We said if you don't have similar existing business, but you in fact open a new business, then you get into this conversation. Any other questions on this? They're always deductible as trade or business expenses, above the line. Business investigation expenses that are allowed as a deduction are deductible always above the line. Last possibility. You don't have similar existing business. You don't actually start a new business. What happens with business investigation expenses? No deduction. Wait a second, Jennifer says. But I was actually investigating the business. I was just happened to be smart. After doing all this work, I decided it's not a good idea. So I did not start a business. You're going to penalize me for it? Yes. We don't care. Even if you honestly tried to start a new business, if there is no fraud, it wasn't vacation, you really did this, but you decided not to start, government says we got to cut the line somewhere. Because we can't get into people's mind. On the other side, they say, look, did you eat in restaurants? Did you have a good time? Be happy. But no deduction. Otherwise, how are we going to really find out? You know, we can't get into people's minds. Yes?
This upfront $5,000 deduction available to you is available no matter how much you spend, like on additional.
The question was, is this $5,000 upfront available no matter how much you spend on business investigation? This is what this whole conversation was about. If you spend more than $50,000, that upfront gets smaller and smaller.
But the
$47,000 is not more than 50, so the full $5,000 is available.
okay, so that's available to you no matter.
If you it's available to you as long as you don't spend more than $50,000. But if you spend more than $50,000, every dollar above $50,000 reduces this up $5,000 up front. So if you spend $10,000, you deduct $5,000 up front, the other $5,000 you amortize. Question: what if you spend $3,000? How much upfront deduction? $3,000. You can't deduct something you didn't spend. I don't know, just in case. Yes?
So if I'm already in business and I'm looking to open another business somewhere else, and I don't choose to do that,
Is it similar business? That would be the question.
yes.
If it's similar business, no other conversations, deductible as you incur it, no questions asked. That's category number one. If it's not similar, then we're going to care whether you started a business or not. And if you did not start a business, no deduction. Yes?
Couldn't you bring like other type of proof, like numbers, like charts or survey?
Yeah, you could offer a lot of proof, but the government doesn't care. The government says we're going to cut it at some point. Okay? And if you really think about it, people could come up with so much proof if needed, you know? Like Jennifer could say, I've been having those lunches with chefs, accountants, lawyers, all about investigation the business. And the IRS will say, no, you were just dating. Yes. Miss? Does this apply to foreign businesses? Well, yeah, I mean, the question becomes, this law, you know, it's a good question. We should actually make something clear. This is something we explore more in future tax courses, should any of you decide to enroll in our master classes. But on the basic level, something I briefly mentioned before, US has a very interesting system of taxation. It's called worldwide taxation. If you are a citizen or resident of the United States, we don't care where you make money. You pay taxes in the United States. Okay? So, therefore, the approach will be very similar, opening a business in US or abroad. Now, with certain countries, and when we talk about international taxation, there are certain, it gets a little bit tricky. There are separate laws. And if you pay taxes in other countries, you may or may not get a credit against US taxes. Again, this is something that, for those of you who become interested, and usually a significant portion of you will enroll in our Masters in Tax courses to diversify your educational background. And for those of you who will be interested in opening your own businesses, perhaps, tax will be a good ground. Tax background and degree will be a perfect ground to do that. And also to have more than one major, more than one opportunity. For those of you who will decide this is for you, this is where you'll pursue, and this is where we'll be exploring, and where we have separate courses for international taxation, real estate taxation, state and local taxation, partnership taxation, states. I mean, that's where the magic really starts happening, okay? Any other questions? Hold on, Jennifer. Yes?
Is there a limit on the simulation, for example, and it should be 1 million?
Yeah, $1 million, as long, but remember, all the expense has to be ordinary, necessary, and reasonable, right? So if it's established that, I had to spend $1 million to investigate whether I should invest $1 billion, that's very reasonable. If you spend $1 million on a $20 business, that's probably not reasonable, right? Yes, Ms.
When you incur, what if you don't open the business until maybe like 2 years later? Is that a big one?
Oh, what a good question. What a good question. What a good question. These are deeper thoughts that we explore in higher level of courses. But let me first repeat the question. The question was, what if you don't start a business and you don't get a deduction, but then you start a business 2 years later? Ooh. These questions give me goosebumps. Any thoughts? Anybody on this good question? Yeah, but once you start a business, let's say 2 years later, then what?
Then you can incur the expenses for that year.
No, but what about all those expenses she incurred before in order to start that business, which you started 2 years later?
You can only deduct the expenses that she incurred while she was in
Is there a statute of limitations on the business expenses?
Is there a statute of limitations? Okay. Any other? All good points. Yes.
Is the tax benefit rule?
Ooh. Tax benefit rule. Would it apply? So, excellent question. The answer first has to be what? What is the first issue that we have to address when we talk about this type of situation? You open the business 2 years later or 10 years later. The question becomes, the fact that you incurred all those expenses investigating at that time, do they really relate to the fact that you opened business now, right? Is there a relationship? And the further the time, the longer the time from the time you investigated to the time you actually started the business, the murkier it starts looking the connection between the two. So, if you're able to establish that the business you opened 2 years later actually benefited and was because of those expenses you incurred up front, you will be allowed a deduction now when you actually start a business. But you'll have to demonstrate that there is a connection. Okay? These are a bit more complicated topics, but this particular one I think it's okay to discuss in class. Okay. Yes, Jennifer, back to you.
Sorry, just one more question.
Yeah, you're allowed. We started with you. We have to end with you.
Incur expenses in switching from a specific type of business, but decide that you are opening a business with a different trade, are they still
They have to relate. Business investigation expenses have to relate to the business. So if your position is that, look, I was investigating what business to open, I wasn't tied to this particular restaurant, I was just looking for business opportunities. And I'm just entrepreneur, whether it's restaurant, whether it's bike rental or dance club or, I don't know, massage place, I don't care. I just need a business opportunity, then there is an argument to be made, I believe. Okay, ladies and gentlemen, so we're cruising right along, right? We started with trade or business, the ultimate form, the most benefit from tax perspective. We scaled down a bit into section 212 because while we had expectation making a profit, we didn't really do it seriously, continuously, all that stuff. And then we said, wait a second, what if we don't even have a trade or business yet? What happens to those investigations? And as the topic we just covered. And now we finally come to the moment we've all been waiting for. And that is the break. No, kidding. What happens if you do something, but you could care less whether you make money or not? Anyone here has any hobbies? Oh yeah, I keep forgetting you guys have no life. There must be somebody with some hobby. Okay. What's your hobby? What's your name again? I'm sorry. Don? Idan, that's right. Idan, what's your hobby? Snowboarding. Cool. Very nice. I'm into skiing more. I actually think snowboarding is much more fun. But I think it's too late in the game for me to switch. I can't take any of those bruises anymore. I ski all the time. In fact, last weekend I skied. And I always I really want to do that, but I see these snowboarders, and they spend more time on their butts. And I just can't deal with that anymore. But in any case, let's talk about Idan's passion and hobby, snowboarding, okay? So Idan, what type of expenses do you incur in your hobby of snowboarding?
There's a lift ticket.
Okay, so there is lift. Do you get lift one by one? Do you get season pass? One by one. So you're really not a true snowboarder. But that's okay. You're a smart snowboarder, right? I'll pay for it when I need it. I agree. Not like me, an idiot, who this year bought season passes with this horrible winter, ended up skiing just a few times. But in any case, lift tickets, how much about? $60. Ooh, you snowboard in good places. And for the year, about how much? Okay, so $300. I have a secret for you. For $300, you could get annual pass. And you could get more if you decide to. But if this is how much you ski, maybe it doesn't make a difference. Okay. By the time I finish with this example, he's going to give up his passion. All right, I'm kidding. All right, lift. What else? Equipment. Well, there is amortization, right? Because if you use it over the years. So let's say, I don't know how much you spend, but let's just say $100. What else? Getting there, so transportation. Let's say how much? Okay, let's say $500 for the year. What else? Lodging. Let's say, I don't know, $400 for the year. You're splitting with other aficionados. What else? Possibly, but let's not worry about food for now. Although I know you get very hungry after doing that stuff. Do you subscribe to any magazines by any chance? You should. Okay. You belong to any clubs? You should. Right? All the ordinary, necessary, reasonable expenses, right? And so on and so forth. So, Idan, all this money you spend, and how much, by the way? Let's look at it. $900, $1,000, $1,300. Are they deductible? Now, Idan, I have a question for you. Don't you have to store this equipment somewhere? Sure. Don't you have a space in your home where you allocate to keeping all that stuff? It's pretty bulky, wouldn't you say? Of course. And if you happen to own your apartment, let's say, right, that space I'll share with you that you allocate for this type of activity, that part of those expenses, which is what? Mortgage interest and property taxes. And let's say mortgage interest is, oh, I don't know, $700 maybe a year, and property tax maybe $200 a year, get allocated towards activity too. Because if this was trade or business, wait, can you make money in snowboarding? Of course. How can you make money in snowboarding? Yeah, you could get money being sponsored, or as you jump, you wear those nice glasses, and it's advertising for the company. So you could make a lot of money. Let's say you done made, I don't know, how much? I have no idea. Let's say $1,000 in revenue. Okay? So if this was a trade or business, and by the way, we just bumped up your expenses by $900, so it becomes $2,200 in expenses, right? So if this was trade or business, if you did it professionally, if this was your trade or business, which means you had expectation of making profit, right, regularity, continue, all that stuff, you would pay taxes on this $1,000, and you'd be able to deduct $2,200 in expenses, right? In essence, you have a loss. Everybody understands it? But he doesn't have expectation of making a profit, right? Because it's his hobby. So what do we do? What do we do? Well, before we talk about what do we do, let's first step back. Did you see what I just said? If this is a trade or business, all of a sudden he's got $2,200. All those ordinary, necessary, reasonable expenses get deducted. So the biggest question, the biggest battle that we need to figure out, and let's put Idan aside for now because he admitted to us that that's his hobby and that he doesn't do it for money, right? Even though he may make some money once in a while. The question to the client is this your trade or business? And of course, people like deductions. So some people say, of course it's my trade or business. Of course I do it for profit, even though I don't make any money, or I'll lose more. So the biggest question is, how do we tell, or how do we establish something is a trade or business, or something is a hobby? So again, we look at, as always, facts and circumstances. How serious are you about it? When trying to determine, because ultimately it's all about whether or not there is expectation of making a profit. Everybody understands? If there is no expectation of making a profit, we in hobby rules, and I'll teach you hobby rules, and that's going to be easy. The real question is, maybe it's really trade or business, which means maybe you really have an expectation of making a profit. Well, how do you prove? What would we want to know? What would we want Idan to demonstrate when he's trying to prove that it's actually, he does have expectation of making a profit, and therefore it is trade or business, and therefore all of these expenses should be deductible? Yes. So ultimately, the ultimate proof is, hey, I actually make money on this, right? And guess what? The government came up with what's known as rebuttable presumption. Please write it down. Rebuttable presumption. Rebuttable presumption. Rebuttable presumption. Okay? Now, what does the term rebuttable presumption mean? We'll come back to it. But let me tell you what this rebuttable presumption says. If taxpayer shows profit, are you with me? If taxpayer shows a profit in 3 out of 5 consecutive years prior to the year in question, right? 3 out of 5 consecutive years prior to the year in question. And if you happen to love horses, for horses it takes longer to make money, so it's 2 out of 7. some congressmen are into horses, so they had to create an exception for horses. Okay? But if you are regular business, 3 out of 5 years, and if you're in horse-related business, it's 2 out of 7 years. If you show that you made profit in these 3 out of 5 or 2 out of 4, what happens? Ooh. Okay, before we answer this question, we have to go back. What does rebuttable presumption mean? All right, what does presumption mean? It's like assumption, right? To presume something is to assume something. So we'll assume something, right? What does rebuttable means? From the word rebut, it says, yes, we'll presume it, but, right? So it's assumption which could be proven otherwise. So this is a little bit sophisticated, complicated, but what it really means is it talks about burden of proof. Who has to prove what when it comes to the taxes? Who has the burden of proof? Remember we talked about burden of proof? Taxpayer. So it is taxpayer has to prove that it's trade or business, not a hobby, right? Remember? Burden is on taxpayer always, except for criminal cases. The government says, if you prove 3 out of 5 or 2 out of 7, it doesn't mean you have a trade or business. It simply means now the burden of proof shifts on to IRS. And now IRS has to prove that it's actually a hobby, not a trade or business. So this is a very important point to understand and appreciate. Satisfying this rebuttable presumption doesn't mean that now you're go home free and it's trade or business and everything's deductible. It simply means now you don't have to get up and say, remember, burden of proof, you come to court, okay, the case number 375, Jennifer versus IRS. Jennifer, the burden is on you to get up and start going, I do have expectation of profit. I do all these things. I do all these things. Government says, wait, you don't have to do anything. Did you make money in 3 out of past 5 consecutive years? Yes? Let's sit down, relax. Now the IRS has to get up and go, yeah, she made 3 out of 5, but she still doesn't care whether she makes money. She's just been lucky, Is that clear? That's all the burden does. It just makes life easier for one of the parties. So ultimately, it's going to be about proving what elements are we looking for to try to establish if somebody is actually in the trade or business. Somebody has expectation making a profit. Well, you have a list in the book, but it's anything and everything. How serious you are about the business, how much time you spend in the business, what is the history of similar undertakings in the past. Yes?
What if I'm a really, really bad snowboarder?
What if you're a really, really bad snowboarder?
3 out of 5 years, I don't really stop. I'm losing money.
You're losing money over and over and over.
But this is what I do. I focus my time on it, and I'm dedicating it more than like a normal hobby. But this is, I consider my business. I have an income. Let's say, for instance, in this case, I made $1,000, but my expenses are $2,200.
So you have to have, the key is you have to have expectation of making a profit. But your expectation has to be reasonable. So if you keep losing money over and over and over and over, year after year after year after year, and by all means everybody looks at you and says, Idan, you're horrible. There's no way anybody ever will pay you a penny. Then you could believe whatever you want to believe. But ignorance is not a defense in court. So if your expectation is unreasonable, and you've been losing money. Now, just because you lose money year after year, look at Amazon. Amazon been losing crazy money for crazy amount of years, millions and millions and millions and tens of millions. Doesn't mean it was somebody's hobby. Was it his name, Bezos? Was it his money? Was he just into some hobby? No, it was reasonable, takes losses many years, but then you start turning into profits, right? So everything has to be reasonable. So just because you don't make money doesn't mean it's a hobby. As long as you can prove you have expectation making a profit, and as long as your expectation is reasonable. So where are we? You have to prove that you have expectation making a profit. How do you do that? All facts and circumstances. And for those of you who are curious about full list, you could look at examples, more examples on page 17. You know, what activities conducted in business matter, or do you just do it when you want to ski or snowboard? How much time you spend, what is the investment you made, history, relationship, profits, losses incurred, tax benefits, anything and everything goes, okay? But if you satisfy 3 out of 5 or 2 out of 7 for horses, you don't have to prove anything. The burden now shifts to IRS. They have to prove that it's hobby. And again, they're going to go back to the same list. Yeah, he made money, but he's never there, doesn't spend any time, doesn't treat it seriously, and all that stuff. Is that clear? All right. So if you fail at this stage and you fall into hobby losses because you treat it as hobby, well, then hobby rules apply. And that's what I'll cover with you right now. But before I do, just want to answer one more question. Yes?
What if you've been in the business less than 5 years, or like you can't?
You still need to prove 3 out of 5 or 2 out of 7. So if you weren't in the business for 5 years, it doesn't matter. You need to show 3 years. It just, which 3 years? 100 years ago? No, past 5 years. So if you were in the business for 3 years, it's okay. If you made money in all 3, the burden is now on IRS. If you were in the business just 2 years, you can't possibly show 3 years. The burden is on you. All right. So hobby rules get very interesting. Are you ready? First, it's about personal expenses. Do you guys appreciate this? Because we said personal expenses. Your breakfast that you ate today, is it deductible? No. The clothing you're wearing right now, is it the cost of it deductible? No. Why? Personal expenses, a general rule, no deduction. Remember that? So hobby that you do for pleasure, expenses, same idea. It's personal, non-deductible expenses. But the government said, if you make money from hobby, we can just simply tax you on your income and not give you any break on expenses. So when it comes to hobby, the government says, number one, hobby expenses are deductible up to income from hobby. That's the first rule that you need to write down. In other words, losses from hobby, no deduction. Right? Income minus expenses, if it's a loss, no deduction for losses. But expenses up to income, up to revenues, since I'm talking to accountants, I have to be careful with terms, up to revenues are deductible. Right? Is that clear so far on the rule number 1? Any questions on rule number 1? Yes?
So if it's a loss, the remaining expenses are...
So right now, we have $1,000 in revenues, $2,200 in expenses. How much is your loss? $1,200 of these, out of these 2,200 expenses will not be deductible. They're gone with the wind, lost, bye-bye. Never see you again. Really? Yeah. Why? You have fun. You don't care whether you make money. It's hobby. Personal expenses. Is that clear? But $1,000 out of all these expenses, $1,000 will be deductible against income because you have $1,000 in revenues. Is that clear? That's step number 1. Step number 2. You ready? We're about to go to break, so a few more minutes. Maybe more than few. We'll see. Next step. Ladies and gentlemen, I need your attention. Everybody look at me right now. You don't have to smile, but look at me. Question for you. Look at all these expenses. How pretty they are, right? You are told in rule number 1, step number 1, that only 1,000 out of these expenses will get deductible. Question for you. Do you care? Remember our conversation about caring? Wasn't that beautiful? Some of you are like, no, it wasn't beautiful. Do you care which of these expenses will get deducted against this? Oh, I see a lot of people caring. Can I see some hands? People who care? All right, Eden, since we've been abusing you today, I'll let you tell me, why do you care? Yeah, because Eden is saying, look, these expenses, property tax and mortgage interest, are known as otherwise deductible expenses, because even if I don't allocate them towards hobby, I can still deduct them. So Eden says, wait, don't write. Nobody writes right now. I want you to listen. Eden says, I would like to allocate other expenses here so I could deduct them, not mortgage, interest, property taxes. I will be able to deduct that anyway. Everybody understands it? And this is exactly why the government doesn't allow you to do this. So when figuring out which expenses could be deducted against income from hobby, please write down the ordering rule, which is very important. First, we must deduct, guess what? Otherwise deductible expenses, which in this case, mortgage interest and property tax. Okay?
Why would I want to write that down? I'm going to get the deduction anyway. Why would I want to associate the hobby with my...
Oh, what a good question. Let's finish this and then we'll come back to your question. That's a good question. So first, you allocate otherwise deductible expenses. Then you allocate all other expenses. All other expenses except for depreciation and amortization. Okay? And lastly, you allocate amortization, depreciation. You may ask, why last? Well, because it's amortization, depreciation expense is a little bit more complicated. They affect your basis. A lot of people make mistakes, so we just leave them for last, okay? So, what does it mean? What does it mean? What it means is, first you allocate mortgage interest and property tax, and how much do you have in that? $900, right? So, you allocate $900 of mortgage interest and property tax. And then how much room do you have left for all the other expenses? Just $100, right? And it doesn't matter which of these, right? So you could just allocate, let's say, equipment, $100. Okay? Whatever, or this the amortization, so it doesn't matter. Is that clear? All the other expenses not deductible in this case. All right? Now, Eden asked a brilliant question. He said, if I know that I have to allocate mortgage interest property tax, why would I want to allocate it to this, right? Answer. First of all, you don't have a choice. If you are using part of the home for the business, right, for these hobby activities, you have to allocate. But it doesn't mean you cannot do tax planning. What does that mean? What does that mean? Don't keep your snowboards in the house. Keep it in a shed outside the house, for example. It will reduce. There's not going to be any mortgage interest anyway, possible, very small, whatever relates to the land, and so on and so forth, okay? So that's rule number 2, okay? The allocation rule. You allocate all expenses except for depreciation. First, otherwise deductible, then all other expenses, then depreciation. Third rule. Ladies and gentlemen, hobby expenses, what type of expenses are these? Are these above the line or below the line? Below the line. Itemized deductions. So write down. Hobby expenses are itemized deductions, which are deductible below the line. And not only they're deductible below the line, they're also deductible subject to 2% of adjusted gross income floor. Okay? So hobby expenses are deductible as itemized deductions subject to 2% of adjusted gross income floor. You got that? Everybody write it down? Last point to write down. Otherwise deductible expenses, even though they're allocated to hobby, they're deductible in full, right? The law says mortgage, property tax. So write down 2% floor does not apply to otherwise deductible expenses. 2% floor does not apply to otherwise deductible expenses. You got that?